Welcome everyone to the latest edition of the JMI Wealth monthly video update. Now we're filming this in early September and the year feels like it's really flying past now. I suspect some of you are also now juggling November and December, Christmas and end of year functions, which really does make it feel like the end of the year is rapidly approaching. Now it's been a fascinating month for financial markets. We've seen volatility in share markets and we've seen a big shift in interest rate policy in New Zealand. So there's lots to talk about this month. Early in August, it was share markets that took centre stage, and a market that we don't often talk about, which is the Japanese share market. Now, I use an index called the Nikkei 225 when I talk about the fortunes of the Japanese share market. It had come under some pressure in July, falling around 10% from the middle of the month to the end of July, but that did follow a similar rise from mid-June through to mid-July. So in late July, the index was really just giving back recent gains. But the real action came in August when the index fell precipitously, losing approximately 20% of its value in the first week or so of the month. Now, this was prompted by a couple of factors. We saw a surprise interest rate hike by the Japanese central bank, and it was combined with rising concerns about the possibility of a recession in the US. Now, these together triggered a substantial unwinding of the popular yen carry trade. In other words, investors borrowing yen to finance the purchase of risk assets like Japanese equities. And what we saw was selling in Japanese equities, and that selling rapidly snowballed. Now, this had a not unexpected contagion effect into other share markets, although the magnitude of the contagion was far more muted in other jurisdictions. The important US S&P 500 index fell approximately 6% over that first week in August. Now, Australasian markets reacted to a far lesser degree, and as we speak, the US market has recovered all of those losses and is now trading back close to all-time highs. Now, look, there's still plenty of debate over whether the US economy can actually achieve a soft landing, so that's avoid a recession. Our investment view is that a period of low growth seems likely, but from an investment perspective, the focus on the economic recovery that we are likely to see in 2025 will provide support for US shares. Look, we're also very mindful of the continuing positive assessment for growth in US company earnings. Now, US listed companies have recently reported their second quarter earnings and they met analyst expectations. Now, consensus expectations have that earnings growth continuing over 2024 and into 2025. And if earnings are growing, that's positive for share markets. And we believe that's supportive of holding global equity positions at long-term recommended strategic asset allocation positions. Look, but arguably local markets were more affected by the most recent RBNZ monetary policy statement and the cash rate announcement. Now, over the first half of this year, the local bank had consistently held to the view that the official cash rate needed to remain at the current restrictive level, so at 5.5 right through 2025 into early 26. And that was to ensure that inflation was held in check and returned to the target midpoint of that 1% to 3% target range. Now, in July, at the Monetary Policy Review, there was this veiled reference to a softening of that stance, and that prompted the start of a move lower in wholesale interest rates. Now, in the August Monetary Policy Review, and that was accompanied by a monetary policy statement, that reference was acted on, and the official cash rate was lowered by 25 basis points from 5.5 to 5.25. But far more importantly, the overall tone and stance of the central bank changed markedly. The bank made material changes to their forecast for inflation, to their forecast for growth, and to their forecasts for the forward track of the official cash rate. And there was more focus in the monetary policy statement on high-frequency data series, which now, in the bank's view, point to a recent weakening in economic activity and an associated risk that inflation falls more quickly than previously anticipated. Now, the financial markets had been forecasting an outcome of that nature for quite some time. Accordingly, interest rates have continued the downward trend that started in July. Now, it started initially in wholesale rates, but we're now seeing it translate into lower retail rates. So in contrast to the US, New Zealand is now expected to experience a hard landing. And actually, we're probably right in it already. And the RBNZ has forecast another recession in the middle of 2024, or two periods or two quarters of negative economic growth, which, if it eventuates, will lock in a triple dip recession. And that's a pretty rare occurrence in New Zealand economic history. So in the face of what is a pretty dire economy right now in New Zealand, the prospect of interest rate relief has actually lifted business and consumer confidence. We saw that in the ANZ Business Outlook, the ANZ Roy Morgan Consumer Confidence Survey, which were released in the second half of the month. So it does now appear that there could be sort of further acceptance of the light at the end of the tunnel prospect, and that's boosting confidence. But at the same time, household fortunes are going to be affected by a weaker labour market. Unemployment is expected to continue to rise over the next six months. In other words, for households and for consumers, the tough economic environment will be felt for some time. But what does this all mean for financial markets and investing? So despite the downbeat local economic situation, it's been a positive 12 month for investors. If you've been in financial asset portfolios, returns have been quite strong. Markets, as I've emphasised before, are forward-looking. They're pricing where asset prices are going to be. And a more favourable interest rate outlook can create a number of outcomes. It makes dividend stocks look more attractive. Falling long-term interest rates do tend to drive valuations higher. Those improving economic conditions can lift expectations for earnings growth, and cyclical stocks come back into focus. Now, in the last video, we said that the big picture may be shifting and that reviewing your asset allocation strategy is important when these big shift changes occur. We continually monitor and review those portfolio asset allocation positions, and last time we said we were holding the view that the central bank would indeed cut rates sooner than they were forecasting, and that investment view has indeed come to pass. So keeping abreast of developments in financial markets, making ongoing improvements, making adjustments to your investment portfolio, that's one of the critical benefits of having an experienced financial advisor in your corner. So we'd love to help you, maybe your family trust, with ensuring that those hard-earned investments are being managed prudently and professionally. So feel free to contact us if you want to talk about your investment experience. You know, you can look us up on jmiwealth.co.nz or on Facebook or on LinkedIn. We'd love to hear from you.